The outbreak of COVID-19 has continued to spread across the world. Before, I laid out two scenarios. Firstly, where the COVID virus is contained relatively quickly, leading to a moderate impact on the global economy and markets. And secondly, a worse scenario where the global economy could enter a recession and markets would stay volatile for a protracted period. It now looks like the worst scenario is more likely. The shutdown of large parts of Europe and the US will undoubtedly have a major impact on their economies. But of course, firstly, we hope that the measures are effective in stopping the spread of COVID-19. The analysis is currently telling us that the world's major economies will slip into recession this year, with the potential for it to last anywhere between 1 to 4 quarters. Its length and severity are largely dependent on the impact of fiscal and monetary policy measures from the authorities. The good news is that a lot of new measures have been announced over the last week to help counteract the slowdown. Governments have committed to significantly increasing the spending, and central banks are using all the tools at their disposal to ensure the smooth functioning of financial markets. We think policies that target the consumer and industries heavily affected by the virus outbreak will be the most helpful. The US appears to be making positive steps in this direction, discussing a $1.2 trillion government spending plan that includes cash handouts to consumers and loans to small businesses. European policymakers are also saying the right things, but we do not have yet seen the details of the plans. Importantly, these policies need to pass through into law efficiently for them to start benefiting the economy. And this is shaping our short to medium-term views of markets. I still think the US and China are best placed to react, which should support the stabilization of US and Asian markets. As a result, we continue to favor these regions in the fund, but we do so by taking a defensive approach, focusing on high dividend equities with exposure to companies that are less sensitive to the economic cycle. This should continue to help mitigate some of the market volatility. However, it is still too early, we think, to add to equities. Until we see a significant slowdown in the growth rate of the new COVID-19 cases, when the growth rate of the virus slows, I will be looking at short-term money markets, safe haven currencies, and the oil price for signs of stabilization. And we are not seeing that yet. We continue to hold our US government bonds that have performed well. Yields have been pushed to record low levels, but the recent steps taken by the US Federal Reserve to provide liquidity to markets and the economy should keep them pinned down. Our holdings in investment-grade bonds have come under pressure in recent days, but I don't have immediate concerns over high-quality companies' ability to meet their debt obligations. We've had some exposure to Asia corporate bonds. We're also retaining our Asia high-yield investment. The asset class has not been immune from the market stress recently, but it continues to perform better than the US and European high-yield markets while offering an attractive income that helps cushion some of the price volatility. There is a greater risk that bond defaults pick up, but again, I expect that Asian market to do so better than the US market, which has a large exposure to energy and retail companies. That's for the US market. One area we're looking at closely is emerging market debt. It has been sold off with other risk markets, which could create an opportunity to invest at good valuations, especially if US interest rates remain on hold at these levels for an extended period. But more positive news is needed before investing. Finally, these extraordinary levels of market volatility and the uncertainty caused by the COVID-19 outbreak can easily lure investors into focusing too much on short-term market moves and distract them from long-term investment goals. It is important to maintain some perspective. Economies always move in cycles, and while we appear to be entering a slowdown, a recovery will at some point follow. The economic cycle is also a critical determinant of asset class performance. Defensive assets, such as high-quality bonds, typically outperform in recessions, whereas growth assets, like equities, outperform during recoveries. We have the flexibility to tilt the fund towards those areas we think will outperform according to the economic cycle, and it is currently defensively positioned. However, it is also important to remember that tactical asset allocation tilts are only one investment tool for generating returns. There is no substitute for ensuring a portfolio is well diversified, which smooths market fluctuations and in line with an investor's long-term financial plan.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书和投资人须知。